Disclaimer.
AG here, and before you ask, yes, I bought silver 2 weeks ago, and no, I'm not legally allowed to say, I told you so. Without adding that this is educational content only. When your corner dealer is charging $120 for something the market insists costs $77, you're either getting robbed or witnessing the kind of price dislocation that creates generational wealth transfers. Let me show you which one this is. 48 hours ago, Elon Musk posted 3 words on X that sent a shockwave through financial markets most people didn't even know existed. "This is not good," he wrote, sharing a chart that showed something unprecedented happening in the silver market. Within 6 hours, that post had been viewed 17 million times. The comments section filled with confusion, speculation, and a growing sense that something fundamental had just broken in the global financial system. Here's what Elon saw that most of us missed while we were celebrating New Year's Eve. Physical silver dealers across America were selling 1-ounce coins for $120, while the official market price on your financial apps still showed 77. That's not a typo. We're talking about a 56% gap between what silver theoretically costs and what you'd actually pay to hold a physical coin in your hand. This kind of divergence hasn't happened since 1980, when the Hunt brothers tried to corner the silver market and the entire commodity system nearly collapsed. But this isn't some billionaire manipulation scheme. What's happening right now is far more systemic, far more dangerous, and it started exactly at midnight on January 1st, 2026, when China flipped a switch that eliminated 93% of the world silver refiners from export eligibility overnight. Think about that scenario for a second. Imagine waking up tomorrow and discovering that 93% of gas stations in America can no longer legally sell fuel. That's essentially what just happened to the global silver supply chain, except most people have not noticed yet because they're not the ones desperately trying to source industrial-grade silver for manufacturing plants that will shut down without it. The mechanism is brutally simple and perfectly legal. China's Ministry of Commerce released new export licensing requirements on January 1st that sound reasonable on paper. Refiners need to demonstrate 80-ton annual production capacity and maintain 30 million credit lines to qualify for export licenses. Sounds like basic quality control, right? Here's the problem. The vast majority of refiners globally can't meet those thresholds. They're smaller operations, family businesses, regional facilities that have been refining silver for decades, but simply don't operate at that scale. According to documents circulating among precious metals dealers, China now controls approval for 60 to 70% of global silver refining capacity. And they just created a regulatory framework that ensures only the largest, most controllable refiners can participate in international markets. The approval timeline, 4 to 6 weeks minimum. The success rate for applications? Industry sources are reporting less than 20%, even for refiners who technically meet the criteria. Between December 27th and January 1st, something extraordinary happened that should have made headlines everywhere but got buried in holiday noise. Industrial buyers across electronics manufacturing, solar panel production, and electric vehicle battery sectors started receiving identical emails from their Chinese suppliers. Contract cancellations, immediate termination. The reason cited in every case, inability to meet new export licensing requirements. We're talking about 400 million ounces of annual supply that suddenly vanished from global markets. To put that in perspective, total annual silver mine production worldwide is roughly 800-900 million ounces. China just removed nearly half of tradable supply from the equation, and they did it during a week when most Western traders were offline celebrating the holidays. Now here's where you need to pay attention to what's happening in your own financial reality. If you're planning to buy solar panels for your home this year, silver is the critical conductor in photovoltaic cells. There's no substitute that works at scale. If you're invested in electric vehicle companies, silver is essential in EV charging infrastructure and battery management systems. If you own electronic stocks or have retirement funds in technology sectors, every smartphone, laptop, and data center requires silver for optimal electrical conductivity. The industrial buyers who got those cancellation emails are now scrambling to find 400 million ounces of replacement supply. There's zero inventory buffer available. Solar manufacturers in California and Texas are already reporting to investors that they are looking at potential production shutdowns in February if they can't secure silver supplies. EV charging network installations are being delayed. Electronics assembly lines are revising their quarterly production targets. And here's the truly remarkable part that reveals how sophisticated money moves while regular investors sleep. Google Trends data shows that searches for how to buy silver hit an all-time record on December 30th, surpassing even the 2011 peak when silver briefly touched $50 per ounce. Somebody was paying attention. Somebody understood what was coming. While you and I were watching football games and making New Year's resolutions, institutional buyers were quietly executing massive physical silver purchases. Industry sources in Utah, where several major private vaults operate, report that multiple 100 million plus orders were processed during the holiday week. London vaults, which handle the bulk of global precious metals storage, saw similar activity. These weren't speculative trades. These were strategic acquisitions by entities that understood the supply shock that was about to hit. The divergence between paper silver and physical silver tells you everything you need to know about what's really happening. When you look at COMEX futures or ETF prices, you're seeing what silver costs in the theoretical world of financial contracts. Paper promises, backed by the assumption that physical metal will always be available for delivery when needed. When you look at dealer premiums on actual coins and bars, you're seeing what silver costs in the real world, where industrial manufacturers desperately need the actual metal to keep production lines running. That gap is now wider than it's been in 45 years. The paper market is still pretending everything is normal, trading silver around $77, $76 per ounce based on historical supply-demand models that are now completely obsolete. Meanwhile, try calling a major bullion dealer right now and asking for immediate delivery of 1,000 ounces. The quotes you'll get, if they're even willing to commit to delivery, will be 30 to 50% higher than the official spot price you see on financial websites. We're watching a supply shock unfold in real time, and most people won't understand what happened until months after the opportunity to position themselves has already passed. China didn't announce this regulatory change with fanfare or warning. They implemented it on New Year's Day when Western markets were closed and attention was elsewhere. By the time institutional traders return to their desks on January 2nd, the physical market will have already repriced reality, while paper markets lag behind in confusion. This isn't speculation or conspiracy theory. These are verifiable regulatory changes implemented by the Chinese government, documented contract cancellations sent to industrial buyers, and measurable divergences between physical and paper markets that any dealer can confirm. The question isn't whether this is happening. The evidence is overwhelming. The question is what happens next when industrial demand collides with evaporated supply and financial markets finally wake up to the new reality. The math is about to get very uncomfortable for anyone who assumed silver would always be available at predictable prices whenever they needed it. Let me show you exactly how empty the cupboard really is, because the numbers here are genuinely shocking when you understand what they mean for industrial supply chains and investment markets. According to COMEX data, the official commodities exchange where silver futures trade, registered inventories available for physical delivery have collapsed 70% since 2020. We've gone from roughly 140 million ounces sitting in approved warehouses to just 42 million ounces today. Now, 42 million ounces might sound like a lot until you realize that global industrial consumption runs at about 500, 600 million ounces annually. What we're looking at in COMEX vaults represents roughly 30 days of global industrial demand. That's it. 1 month of buffer between normal operations and total supply chain breakdown. And that's assuming every single ounce in those vaults is actually available, which industry insiders will tell you is a generous assumption, given how much of that inventory is already committed to specific contracts. The London Bullion Market Association vaults, which handle the majority of global precious metals storage and settlement, tell the same story. LBMA data shows London silver holdings have dropped 40% over the past 3 years. These aren't retail investors buying a few coins. These are institutional withdrawals, central banks diversifying reserves, and major industrial buyers securing multi-year supply agreements outside the traditional market structure. Shanghai inventories paint an even more alarming picture. According to FX Street reporting on Shanghai Futures Exchange data, Chinese silver stocks hit decade lows below 500 tons in November 2025. That's remarkable because China is simultaneously the world's largest silver consumer and now the gatekeeper for most global refining capacity. They are drawing down their own reserves while restricting exports, a combination that suggests they understand something about future supply constraints that hasn't fully registered in Western markets yet. Here's where the strategic chess moves become visible if you know what to look for. October 2025 saw China export a record 660 tons of refined silver, the highest monthly total in years. At the time, market analysts called it a bullish sign, proof that Chinese supply could meet global demand. What they missed was the timing. Those massive October exports happened exactly 2 months before the January 1st licensing restrictions kicked in. Ministry of Commerce documents obtained by precious metals dealers reveal the brutal reality of the new system. Refiners who successfully obtain licenses, and remember that less than 20% of applicants, even among those who meet the stated criteria, face approval timelines of 4 to 6 weeks for each export shipment. Think about what that means operationally. An electronics manufacturer in California needs silver delivered by February 15th for a production run. Under the old system, they'd place an order with their Chinese supplier in early January and receive shipment within 10-14 days. Under the new system, the refiner needs to apply for export approval in early January, wait 4 to 6 weeks for government processing, then ship if approved. That puts delivery in late February or March, missing the production deadline entirely. Multiple refiner contacts have confirmed to industry publications that they're being forced to choose between serving domestic Chinese clients or attempting to navigate the export approval gauntlet for international customers. The economically rational choice is obvious. Focus on the domestic market where there is no regulatory uncertainty and payment is guaranteed. This effectively weaponizes the 60-70% of global refining capacity that China controls, turning it from internationally available supply into domestically allocated resources. What really validates the severity of this situation is watching what the smart money is doing while everyone else debates whether this matters. The gold to silver ratio, a metric that measures how many ounces of silver it takes to buy 1 ounce of gold, has dropped below 65 for the first time in years. Historically, this ratio has averaged around 80, meaning silver has typically been much cheaper relative to gold than it is right now. You might think a falling ratio means silver is getting expensive and due for a correction, but here's what institutional analysts are actually saying. The historical natural ratio, based on the relative abundance of silver and gold in the Earth's crust and industrial demand patterns, should be somewhere between 33 and 35. We're currently at 65. If that ratio converges toward historical norms, while gold continues its projected climb toward 8,000 plus dollars per ounce in 2026-2027, and major investment banks, including Goldman Sachs, have published research supporting that gold target, the mathematical implications for silver are extraordinary. Let's do the math together. Gold at $8,000 divided by a gold to silver ratio of 35 gives you silver at $228 per ounce. Even if we use a more conservative ratio of 50, you're looking at $160 silver. These aren't wild predictions from fringe newsletters. These are the logical conclusions of fundamental ratios, returning to historical norms during a period when supply constraints are tightening and industrial demand is accelerating. And that industrial demand story is only getting more intense. Solar panel manufacturing has become one of the fastest growing sources of silver consumption, with the photovoltaic industry now using 140 million ounces annually, according to the Silver Institute. There is no substitute for silver in solar cells that works at comparable efficiency and cost. Scientists have tried everything from copper to graphene, and nothing matches silver's electrical conductivity at the microscopic scale required for solar wafers. The Biden administration's infrastructure investments and the broader global push toward renewable energy means solar installation targets are increasing 15-20% annually. Every percentage point of growth in solar deployment translates directly to millions of additional ounces of silver demand. This isn't discretionary consumption that can be delayed during price spikes. These are contracted infrastructure projects with federal funding deadlines and penalty clauses for missing installation targets. Electric vehicle manufacturing presents the same inflexible demand picture. Each EV requires significantly more silver than traditional combustion engine vehicles, roughly twice as much according to industry estimates, due to the electrical systems, battery management components, and charging infrastructure. Global EV sales are projected to grow from 14 million units in 2023 to over 30 million units by 2027. That's not a forecast that depends on silver prices staying low. That's locked-in demand from manufacturers who have already committed billions to factory construction and supply chain contracts. What you're seeing in the current price action is institutional money positioning ahead of a supply squeeze they know is mathematically certain. When a solar manufacturer calls their procurement team in panic because Chinese suppliers just canceled contracts, that company has exactly 2 options. Find replacement silver at whatever price the market demands, or shut down production lines and explain to shareholders why they're missing revenue targets. There is no third option of wait for prices to come down when you are facing contractual penalties and market share loss. The Federal Reserve's own data on industrial commodities shows silver inventory to consumption ratios at levels not seen since the 1990s. Back then, governments were selling off strategic reserves, and major mines were ramping up production in response to high prices. Today, government reserves are largely depleted. Most Western nations sold their silver stockpiles decades ago. Mine production has plateaued because most silver comes as a byproduct of copper, lead, and zinc mining. And you can't just dig more silver without significantly higher base metal prices justifying new mine development. The World Silver Survey, published annually by the Silver Institute, projects a structural supply deficit of 142 million ounces for 2025. That was before China, as January 1st restrictions eliminated access to hundreds of millions of ounces of refining capacity. The 2026 deficit forecast will need to be revised substantially higher. And the market is beginning to price that reality while most investors remain focused on the official spot price that hasn't yet caught up. What we're documenting here isn't speculation about what might happen. This is verification of what has already happened and what is currently unfolding in industrial supply chains that most people never see until the consequences reach consumer prices. The inventories are depleted, the regulatory restrictions are in place, the industrial demand is accelerating, and the gap between paper markets and physical reality is widening every day. Now, let's talk about the math that keeps precious metals analysts up at night, because once you see these numbers, you can't unsee the inevitable conclusion they point toward. China's export restrictions just eliminated 400 million ounces of annual refined silver from global markets. That's the starting point. Now we need to figure out where replacement supply could possibly come from, and more importantly, what happens when the numbers simply don't add up. Maximum available replacement capacity breaks down like this. Roughly 150 million ounces of uncontracted mine production that could theoretically be redirected to industrial buyers, 42 million ounces in COMEX registered inventory, approximately 100 million ounces in London vaults that isn't already spoken for, and maybe 25 million ounces spread across dealer inventories and smaller refiners worldwide. Add all of that together and you're looking at 280, 330 million ounces of potential replacement supply. Do that subtraction with me. 400 million ounces of eliminated Chinese exports minus 280, 330 million ounces of maximum replacement capacity equals a structural deficit of 70, 120 million ounces annually. This isn't a temporary squeeze that resolves when one bottleneck clears. This is a fundamental imbalance between supply and demand that starts right now in Q1 2026 and continues until either prices rise high enough to ration demand or someone discovers massive new silver deposits and brings them into production, which takes years, even under ideal circumstances. But here's what makes this situation even more critical than those raw numbers suggest. That 150 million ounces of uncontracted mine production isn't sitting in warehouses ready to ship. Most silver comes as a byproduct of copper, zinc, and lead mining. Only about 30% of global silver production comes from primary silver mines. That means you can't just call up a mining company and say, produce more silver. They're producing whatever comes out of the ground alongside their primary metals. And ramping up production requires massive capital investment and multi-year development timelines. The mining executives I've seen interviewed in industry publications are being remarkably candid about this constraint. One CEO of a major silver producer told Bloomberg that even if silver hits $150 per ounce tomorrow, his company couldn't significantly increase production for at least 3 years due to permitting timelines, equipment procurement, and workforce limitations. The market is assuming that high prices will bring new supply online quickly, but the physical reality of mining doesn't work that way. Here's what that means in plain English. The market is going to have to ration physical silver through price. When you can't increase supply and demand keeps growing, price becomes the mechanism that forces the equation back into balance. Industrial buyers, who absolutely need silver to keep factories running, will pay whatever they have to pay. Discretionary demand gets priced out. And investors who understand the supply-demand fundamentals position themselves ahead of the repricing. Let me give you a concrete example of how this plays out in the real economy. There's a solar panel manufacturer in Arizona that signed contracts in 2024 to deliver 50,000 residential solar installations in 2026. Each installation requires approximately 20 ounces of silver in the photovoltaic cells. That's 1 million ounces they need to source this year. Their contracts were priced assuming $25, $30 per ounce silver costs. At current $77 spot prices, their margins are already compressed. At $120 physical dealer prices, they're losing money on every installation. At 150 plus silver, they face potential bankruptcy unless they can renegotiate customer contracts or breach agreements and pay penalties. Now multiply that scenario across every solar company, every electronics manufacturer, every EV producer globally. You're looking at a wave of contract renegotiations, supply chain force majeure declarations, and price increases that ripple through consumer markets. When that Arizona solar company has to raise prices 40% on new quotes, homeowners delay installations, which impacts renewable energy targets, which affects grid infrastructure planning, which influences utility company investments. One supply shock in one commodity cascades through the entire economic system. The price targets that analysts are now publishing aren't based on hype or technical chart patterns. They're based on mathematical necessity and historical precedent. Triple-digit silver, we're talking $100 to $140 per ounce, is being projected for Q2 2026 by multiple institutional research teams, and here's the three-part reasoning that supports those numbers. First, inflation-adjusted all-time highs. Silver peaked at 50 per ounce in 1980 and again briefly in 2011, But if you adjust those peaks for monetary inflation using M2 money supply growth, which measures the total amount of dollars in circulation, the true inflation-adjusted equivalent today would be somewhere between $590 and $900 per ounce, depending on which methodology you use. We're currently trading at $77. That means silver is still 7.6 to 11.8 times away from its real historical peak when you account for how much currency has been created since 1980. Even reaching a fraction of that inflation-adjusted level puts us well into triple digits. What's particularly interesting is comparing silver's current recovery to gold's path. Gold reached new all-time highs in 2024 and has continued climbing, while silver is still 40% below its 1980 inflation-adjusted peak. Historically, silver has been more volatile than gold in both directions. It lags during the early stages of precious metals bull markets, then catches up explosively once industrial and investment demand converge. We appear to be at exactly that inflection point now. Second, industrial demand growth with zero substitution options. Solar panel installations are growing 15-20% annually according to the Solar Energy Industries Association. And every major economy has renewable energy mandates that require massive solar deployment over the next decade. The International Energy Agency projects that solar capacity needs to triple by 2030 to meet climate targets, which translates directly to silver consumption growth from 140 million ounces annually today to potentially 200 plus million ounces by 2030. EV production is following a similar exponential curve. Global EV sales are projected to grow from 14 million units in 2023 to over 30 million units by 2027, according to Bloomberg NEF. Each EV requires approximately 25-50 grams of silver depending on the model, roughly double what traditional combustion vehicles use, due to electrical systems, battery management components, and charging infrastructure. That is an additional 30-40 million ounces of annual demand just from EV growth over the next few years. 5G infrastructure buildout is the sleeper demand driver that most people don't consider. Every 5G cell tower requires significantly more silver than previous 4G infrastructure, due to the higher frequency signals and more complex antenna arrays. The GSMA estimates that 5G will require $700-900 billion in infrastructure investment globally through 2030. Even at conservative estimates, that translates to 15-20 million ounces of annual silver demand from telecommunications infrastructure alone. The critical factor is substitution, or rather the complete lack of it. Electronics manufacturers have spent decades trying to find cheaper alternatives to silver because it's always been one of their more expensive component materials. They've tested copper, aluminum, graphene, carbon nanotubes, and every other conductive material imaginable. Nothing works at comparable performance levels for the microscopic applications in modern electronics and solar cells. Copper oxidizes too quickly at thin film levels. Aluminum doesn't provide sufficient conductivity. Alternative materials either don't scale economically or can't match silver's unique combination of electrical conductivity, thermal properties, and chemical stability. When you need maximum electrical conductivity in minimal space, silver is the only option that works at scale. That means demand is price inelastic. Manufacturers will pay higher prices rather than shut down production. There's no demand destruction curve where buyers just walk away when prices double. Industrial buyers are captive to silver requirements because their entire production processes are designed around it. Third, the broader macroeconomic environment is setting up for a flight to tangible assets. Equity markets are showing classic late-cycle behavior with elevated valuations and deteriorating fundamentals. The S&P 500 is trading at price-to-earnings ratios that historically signal limited upside and significant correction risk. Multiple investment banks, including JP Morgan and Bank of America, are forecasting a significant correction in stock markets during late 2026 as recession risks increase and corporate earnings disappoint relative to expectations. When that correction comes, investors historically rotate into safe haven assets, and precious metals benefit disproportionately because they're among the few assets that are not simultaneously someone else's liability. A stock represents a claim on future corporate earnings. If the company struggles, your stock value declines. A bond represents a promise to repay debt. If the borrower defaults, you lose principal. Physical silver is just silver. It has intrinsic value from industrial demand regardless of what happens to financial markets. Here's where your personal financial situation intersects with these macro trends in very specific ways. If you have retirement savings and equity-heavy portfolios, you need to understand that diversification into uncorrelated assets becomes critical during market corrections. Historical data shows that precious metals often move inversely to stock markets during crisis periods, providing portfolio protection exactly when you need it most. If you're planning major purchases like solar installations or home renovations that involve electronics and electrical systems, the cost of those projects is directly tied to industrial metal prices. A solar installation quoted at $25,000 in December might cost $35,000 by June if silver prices force panel manufacturers to raise prices. Locking in contracts now while suppliers are still honoring old price sheets could save you thousands of dollars. If you're employed in manufacturing sectors that depend on silver supply chains, your job security is linked to whether your employer can source materials at prices that keep their business viable. Companies facing 50 to 100% increases in critical input costs either pass those increases to customers and risk losing market share, or absorb the costs and face margin compression that leads to layoffs and restructuring. The timeline is compressed and specific, so pay attention to these dates and what to watch for. Markets reopen on January 2nd after the New Year's holiday. Institutional traders will return to their desks, pull up their screens, and start processing the supply shock information that physical dealers have already priced in. Expect a gap-up opening somewhere in the 85-92 range as futures markets adjust to the new reality that physical premiums have been signaling for days. Watch what happens in the first week of January particularly closely. If COMEX sees unusually high delivery requests, that's a signal that industrial buyers are desperately trying to secure physical metal through official channels. If delivery requests spike while registered inventory continues dropping, you're watching a potential short squeeze develop in real time. The paper market has sold far more silver promises than physical metal exists to deliver, and industrial buyers demanding actual delivery could force a reckoning. January will likely see consolidation and volatility as the full scope of contract cancellations becomes visible. Solar manufacturers will start issuing supply chain warnings in their quarterly guidance. Electronics companies will revise production forecasts downward. The financial media, which largely ignored the story during the holiday week, will finally start covering it. As corporate earnings calls reveal the impact on profit margins and revenue projections. Then comes February, and this is where the situation could turn genuinely critical. Solar panel manufacturers facing production shutdowns won't be able to hide the problem anymore. If companies start announcing factory closures or force majeure clauses on their own customer contracts because they can't source the silver, that's when mainstream awareness hits. Retail investors who missed the early move will flood into the market, driving prices through key psychological levels. The breakout above 100 per ounce likely happens in February when industrial supply chain failures become visible to the general public and media coverage reaches saturation. At that point, you're no longer early. You're part of the crowd reacting to news instead of positioning ahead of it. The investors who will do well in this environment are the ones who understand the fundamentals now, while physical metal is still available at prices that will seem remarkably cheap 6 months from now. Think about this scenario from the perspective of a solar installation company you might hire to put panels on your roof. They gave you a quote in December based on 30 per ounce silver prices built into their component costs. By March, their supplier quotes have doubled or tripled. Either they honor your December price and lose money on the job, or they come back asking for a substantial price increase that might kill the deal entirely. Multiply that scenario across every industry that depends on silver, and you start to see how supply shocks ripple through the entire economy in ways that eventually touch every consumer and every business. What should grab your attention is the asymmetry of the situation. The downside is limited by production costs. Silver miners aren't going to sell at prices below their all-in sustaining costs of $18.22 per ounce, which provides a fundamental floor. The upside is constrained only by how high prices need to rise to either ration demand or incentivize enough new supply, which could take years to materialize. That's the kind of risk-reward setup that creates generational wealth transfers from those who react slowly to those who position early. Pop quiz. What's more valuable? Knowing silver will hit $150 after everyone else knows, or understanding the supply dynamics now while dealers are still filling orders? The answer determines whether you're front-running the move or chasing it after prices have already multiplied. Our responsibility as Americans navigating these markets is to understand the forces reshaping our financial landscape and make informed decisions that protect our purchasing power and investment capital. This is not about panic or fear. It's about recognizing structural changes in global supply chains and positioning ourselves accordingly. The silver market is sending clear signals right now through that $120 dealer price versus $77 spot price divergence. The question is whether we're paying attention or whether we will look back in 6 months wishing we'd understood what those signals were really telling us. The mechanism is in motion. The timeline is compressed. The math doesn't care whether we're ready or not. And that $120 price your dealer is charging today, 6 months from now, that might be remembered as the opportunity of the decade for those who recognized what was happening while most of the market was still asleep.